We have some volatility, Sonu. Everyone, welcome to your latest Carson's Take 5. We're calling this one The Toll We Pay to Invest. Sonu, I'll go to you in a second. One thing Burt White, our CEO, Chief Investment Officer, has long said for many, probably decades, not calling Burt old, but for many decades, he said, volatility is the toll we pay to invest. If you want that, what was that?
I said, and we have some.
We have some. If you want to enjoy the gains of, say, 20% 2 years ago, 20% last year, ballpark 15-ish% on the S&P this year, you have to have some scary moments. So I'm going to say one more thing. I'm turning to you. Let's remember in 2023, in March, we had the regional bank crisis. Markets were crashing. Everyone was freaking out. Banks are going to fall apart. We got through it. August of last year, something called the yen carry trade unwind. I hope no one even remembers what I'm talking about, but we do know this. That first Sunday in August of 2004, we went to sleep knowing Japan was having its worst day since 87, and global markets were down between 3, 5, 6, 7%. That really was scary too. And then we got through it. And now here we are, Sonu, with some more volatility. It's a toll we pay to invest. I don't know where you want to take this, but what do you want to add to this conversation?
Look, and then this year, we had a scary moment after Liberation Day, April 2nd, April 9th.
How did I forget? Yeah.
Like almost a bear market, technically a bear market being defined as a 20% pullback from highs, right? And the high was in February and the low was April 9th. And then the White House reversed a lot of its tariffs and all of it. And we had 6 straight months of gains, which is incredible considering
Seven on the NASDAQ. 7 on the NASDAQ, actually.
7 on the NASDAQ. Okay, there you go. And now we have a little bit of volatility. And I stress little bit of volatility. It's not extreme volatility. It's a 3%. The S&P 500 is down about 3.5%, something like that from its recent high. Why is it volatile? Well, I think it's mostly, remember the record high that we recently had was on October 29th. That was the day of the last Federal Reserve meeting. What happened since then? They've gotten a little skittish about cutting rates once more in December, right? And markets are a little upset about that. But markets always find a reason to be upset. Back to your point, the overall picture is there's always volatility. You have to take some risk to earn higher returns. Otherwise, all of us would just sit in cash.
Well said. Again, volatility is the toll we pay to invest. Now on the screen, we're going to share a chart that we've shared many times. As you can see on this chart here, this is on average, right? There's no such thing as average when it comes to investing. But still, on average, Sonu, you see a 3% dip 7 times a year, 5% minor dip 3 times a year on average, once a year on average, a 10% peak to trough correction, and a bear market every 3.5 years approximately. So yes, some years are smoother than others. I'm looking at you, 1995, 2017, but then we have years like 2020, 2022. Of course, 2008 was a terrible one for investors, but then you get through it, right? We just need to remember this is another real cliche one. It's a marathon, not a sprint. But when we have these opportunities, one other funny one I like to use, the stock market is the only place that things go on sale and everyone runs out of the store screaming, right? I've used that a lot. Maybe I've used it on here, but it's important to remember, like if you, I'm not going to mention any individual stocks because I'm not allowed to do that, but there's a particular company you love, that stock's down 25%. You might be scared to buy it, but if your favorite shoes, your favorite jacket, your favorite, socks are down 25%, you're probably going to buy it. And that's the way our brains are wired. It's not our fault. It's happened back in caveman times under the saber-tooth tiger. Our job is to get in the cave and just survive. We do that when it comes to our money. We do that when it comes to religion. We do that when it comes to our families. And it's how we're wired. But that's why working with a financial advisor and listening to some of these, hopefully, these concepts that Sonu and I have talked about for a long time, when the volatility happens, when the scariness happens, do not panic. You can be concerned. You should be concerned. This is your livelihood. This is your money. But don't make an irrational decision, because I'll tell you what, Sonu done this for, almost 2.5 decades. So many times people sell when they can't take it anymore, or buy a bunch when it's up here. You want to kind of have a plan in place ahead of time. I went on a little rant I didn't expect to do, but Sonu, let's wrap this up. What do you want to add here?
And that's why you have diversified portfolios.
There you go.
Right? There's a reason you have diversified portfolios because, yes, all we know there's volatility. The numbers show that. We've shown that there's a little volatility right now in the market. And one thing is, Ryan, we've talked about this before. It seems like sentiment is maybe overly negative, considering we've had, 6 straight months of gain, 7 months for the NASDAQ, 6 months for the S&P 500. And maybe, for all the talk about are we in a bubble or wave or mania with respect to artificial intelligence, that whole AI thing, it seems pretty joyless. It doesn't feel euphoric, unlike previous manias, whether it was a internet boom or, even housing, right? Housing and finance in the middle of the 2000s, and even energy, the shale revolution. There was more excitement about that. Right now, it feels like everyone's very skittish. And partly, I think that's because a lot of people are overly concentrated in the technology space. So anytime you get a little bit of a downdraft, that's your wealth going down by more than you probably expect. This is why, going back to my point about having diversified portfolios.
Yeah, earlier this year, right, from like late January to early April when the market bottomed, semiconductors were down 35%. All right. Now, then they came all the way back up, and now they're down a lot. I mean, if you want to invest in the more aggressive, highly volatile areas, we're looking at tech and tech adjacent. Well, you're going to love the gains, but then when the volatility happens, you have to have that plan in place ahead of time, understanding that that's the way it works. And if you want to reach your long-term investment goals, you have to make sure that you don't let your mind play tricks on you and make a bad decision. Again, remember that chart we shared a little bit ago. Volatility is the toll we pay to invest. With all that, everyone, I guess, let's see, the Thanksgiving already had, no, Thanksgiving's this week. So Thanksgiving's this week. We wish everyone a happy Thanksgiving. Enjoy some turkey, enjoy some family, enjoy some football. Maybe we get this market to bounce a little bit more. We'll enjoy that all as well. But with that, we'll see everyone next week. Thank you. Take care.